Hello students, welcome to my channel again. Today I am going to talk about the risk and return concept. What is risk and what is return? Let's start from the concept of return. Return is the difference between money received and money originally invested at the beginning. If you invested £100 today and got 110 back tomorrow, your return is £10. The formula to calculate the rate of return is ending price minus beginning price plus cash received divided by beginning price. Measurement of returns. It is measured by the probability distributions and the expected rate of return. What is expected rate of return? The expected rate of return is the rate that we expect from the investment in the future is known as the expected rate of return. So, the expected rate of return depends upon the states of economy and the probability distributions of the state of conditions. So, there are two formulas to calculate the expected rate of return. One is expected rate of return is equal to probability of return RJ return on one assets 1 plus probability to return on assets J Pn multiplied by Rj n, where ERJ is equal to the expected rate of return on assets J Pj is equal to probability of occurring jth economic condition and return on J I is equal to rate of return of assets J in ith state. Also, we can calculate the expected rate of return as a average rate of return. RJ, where RJI plus RJ2 plus RJN divided by N, where R-J is equal to average rate of return on assets J RJT is equal to periodic return on assets J, and N is equal to number of periods. Now let's have a look what is risk. Concept of risk. Whenever we are in a situation where the outcome is unknown, we are exposed to risk. It refers to the possibilities that the return expected from an asset or security may not be realized. So how do we measure the risk? Risk cannot be avoided in financial decision making. And along with the cash flow and timing, the risk affects the value of assets. So there are three concepts in risk measurement. One is variance, another is the standard deviation, and the last one is coefficient of variance. So let's have a look each section separately. We have a formula to calculate variance. So variance is measured as variance Rj or sigma square as well. Rate of return on assets J 1 minus expected return on probability 1 plus Rj2 minus expected rate of return on Rj square multiplied by P2 Rjn minus expected rate of return J square multiplied by Pn, or n I is equal to 1 Rji minus expected rate of return on assets J power square Pi. So let's have a look how do we calculate the standard deviation. The standard deviation we can find out is simply sigma j is equal to the square root of variance on assets j, or simply square root of like this. Now let's have a look how do we calculate the coefficient of variance. So coefficient of variance is simply generated by CV is equal to standard deviation divided by expected rate of return on assets J. Let's have a look in portfolio term. What is portfolio and what does it make difference in selection of portfolio? The risk and return on portfolio context. Portfolio is defined as the combinations of various investment. Portfolio deals with the selections of efficient portfolio. The efficient portfolio maximizes the return for a given level of risk or minimize the risk for a given level of return. So the way we calculated the expected return for individual assets, we can calculate expected rate of return for portfolio. So this is the formula for calculating portfolio. ERP is equal to ER1 multiplied by weight of 1 plus ER2 weight of 2 plus ERN plus weight of n, where ERP is equal to expected rate of return portfolio, ERJ is equal to expected rate of return on jth assets, weight of j is equal to the proportion of total funds invested in assets J, and n is equal to total number of portfolio. The risks of portfolio. The way we calculated the risks on individual stock or individual assets, we can calculate the risks of portfolio, which is still the standard deviations. Risks of portfolio is return on portfolio minus expected rate of return on portfolio whole square multiplied by probability of I state. Now let's have a look the concept of diversifications. What is diversifications of risks? It is the process of mixing different assets or securities to reduce the risk of loss. We invest in more than one assets and create a portfolio of assets. There are two types of diversifications. One is simple diversifications and another is Markowitz diversifications. And in simple diversifications, there is two types. One is unsystematic risk, another is systematic risks. What is simple diversifications? Simple diversification refers to the mixing of randomly selected securities in the portfolio. Unsystematic risk is also known as avoidable risk. The risk that we can avoid or minimize is known as unsystematic risks. The example is strikes, lockouts, or breakdowns in factory, which is related to the internal factors of management or organizations. Systematic risks. Systematic risk is also known as unavoidable or undiversifiable risks. Example is inflation, interest rate risks, or reinvestment risk. If you have a look in this diagram, the y-axis is portfolio of standard deviations, which is risk, and the x-axis is number of securities or portfolio. The unsystematic risks is going down as the number of securities in portfolio is increased, but the systematic risk remain constant no matter how the number of securities we increase in our portfolio. If you add unsystematic and systematic risks, you will get the total risk. Markowitz diversifications. Markowitz diversifications, the concept is there is a lower the correlations between the return of the securities, better the portfolio in terms of risk diversification. If correlations is perfectly negative, we completely eliminate the risks. And if the correlations is perfectly positive, we cannot eliminate the risks at all. But in real life scenario, there are hardly any securities that are perfectly positive or negative. So there will be always middle point. Now let's focus on the practical problem to calculate expected rate of return, variance, and standard deviations. We know the formula. The formula to calculate expected rate of return is P1 return on J plus P2 return on J2 Pn return on Jn. You can calculate expected rate of return on A is equal to multiply the return of project A by probability. So 0.2 multiplied by 5% plus 0.2 multiplied by 5% again plus 0.2 multiplied by 10 plus 0.2 multiplied by 2 multiplied by 20. So we get here 0.2 plus 3 plus 9%, and expected rate of return on portfolio in assets B is again 0.2 multiplied by return on 35 plus 0.2 multiplied by return on 25 plus 0.2 multiplied by 15 plus 0.2 multiplied by 0.2 multiplied by minus 15. In this way we get 13%. Let's calculate the variance. RJI minus expected return on RJ square root P1 plus RJ2 expected rate of return multiplied by expected rate of return multiplied by probability 2 RJN minus expected rate RJN whole square multiplied by PN. Now let's calculate return on A minus expected rate of return on A. Return on A we get is minus 5. Expected rate of return in assets A is 9%. So in this way we get minus 14. Over here 5 minus 9 is minus 4. 10 minus 9 is 15 minus 9 is 6. 20 minus 9 is 11. Another column, return on B minus expected return of B. Return on project B is 35. Expected return on assets B is 13 is equal to 22, and 20 minus 13 we get 12. Another 15 minus 13 we get 2. 5 minus 13 we get minus 8. Then minus 15 minus 13 we get minus 28. Next column we calculate return on A minus expected rate A square multiplied by probability. Expected return on B whole square multiplied by probability. We know that return on assets A, so 14 square 14 multiplied by 0.2 is 39.2 minus 4 square multiplied by 0.2, so 16 multiplied by 2 we get 3.2. Then 1 square multiplied by 0.2 we get 0.2. 6 square 0.2 is 36. 36 multiplied by 2 is 7.2. Then 11 square multiplied by 0.2 we get 11 is square 1. 11 is 1 to 1 multiplied by 0.2 we get 24.2. So if we add up this we get summation return on A minus expected return on A whole square multiplied by 2 is equal to, now we get 74%. 74. Now let's calculate for assets to assets B. The return on B is 22 square. 22 square multiplied by 0.2. 22 square 484 multiplied by 0.2, which is 96.8 by 0.2, which is 28.8. 2 square multiplied by 0.2. 2 square is 4. 4 is 0.8. Minus 8 square multiplied by 0.2 is 64. 64 multiplied by 0.2, we get 12.8. Then minus 28 square multiplied by 0.2. 28 multiplied by 28 square multiplied by 0.2, we get 156.8. Let's add up all of this. RB minus expected return on B whole square multiplied by P is equal to, we get 96.8 plus 28.296. So variance for 74, simply square root of 74, we get 8.6. Now variance of assets B is equal to 296. Standard deviations of assets B is equal to square root of 296, 17.2%. Coefficient of variance of assets A is standard deviations of assets A divided by expected rate of return on. So standard deviation of assets A is 8.6, then expected rate of return on assets A is 9%, 0.956. Similarly, coefficient of variance for assets B is standard deviation for assets A, expected rate of return for assets B. We have here coefficient of standard deviations for assets B is 17.2%. Expected rate of return for assets B is 13%, 1.323. Hello students, now let's have a look on portfolios, the risks and return on portfolios. Previously we have done the expected return and standard deviations or risks in separate assets, but now we are going to have a look as a combined or in portfolio. Now we are going to find out the expected rate of return on portfolio, ER1 weight 1 plus expected rate of return on portfolio B, assets B, weight of second, expected rate of return on N, and weight of N, or N summation 1, expected rate of return RJ and J, and weight of J. Now let's assume that we are making 50% on project A and we are investing 50% on project B. So there is equal amount of investment in both. Return on portfolio is equal to 0.5 multiplied by return on assets plus 0.5 multiplied by return on B. 0.5 multiplied by return on A is minus 5 plus 0.5 multiplied by return on B is 35. Then we get here value of 15. Similarly, 0.5 multiplied by 5 plus 0.5 multiplied by 25, we get value 15 again. 5 multiplied by 15 portfolio of B, we get value here 12.5. 0.5 multiplied by 15 plus 0.5 multiplied by 5, we get value 10. Then 0.5 multiplied by 20 plus 0.5 multiplied by minus 15, we get the value 2.5. Another column, which is return on portfolio multiplied by the probability. So we're going to calculate 15 plus 0.2 is 3 now. Again, 15 multiplied by 0.2 is 3. 12.5 multiplied by 0.2 is equal to 2.5. 10 multiplied by 0.2 is 2. Then 2.5 multiplied by 0.2 is equal to, now the portfolio return is this one, which is 11%. Another column is return on portfolio V return on portfolio minus expected rate of return on portfolio whole square. Return on portfolio is obviously 11. Now we know that return on portfolio is this column, which is 15. Expected return is 11. Then we make it square, is equal to 15 minus 11 is 4, 16. The portfolio return is 15, again 11 square, again 16. For average, portfolio return is 12.5, expected return is 11, 2.25. Then portfolio return is again here 10 minus expected return on portfolio is 11, so square is 1, so it's 1. Portfolio return is 2.5, expected return is 11, so 2.5 minus 11 is 8.5, square 72.25 multiplied by 72.25. 72. Let's calculate another column, which is return on portfolio minus expected rate of return on portfolio whole square, then multiply by probabilities. So basically just multiply these values by 0.2. So 16 multiplied by 0.2 is 3.2. Again 16 multiplied by 2 is 3.2. 2.25 multiplied by 0.2 0.45. Then 1 multiplied by 0.2 is 0.2. Then 72.25 multiplied by 0.2 is 14.45. Let's add all of this. If we add column last, we get variance. $21.5. Standard deviation is root square of 21.5, 4.64. Students, now let's have a look in the covariance of returns. The formula for covariance of return is covariance of return return A, return B, or sigma square or sigma AB is equal to n summation I is equal to 1 probability I multiplied by return on A J minus expected return on A multiplied by return on BJ minus expected return on SSB. I'm taking the same example we have done before. So we know that expected rate of return on return on A is 9% and expected return on SSB is 13%. Let's make another column here. Return on A minus expected return on assets A, return on B minus expected return on B. So return on A is, in project A, is -5, expected return is 9, so we get here in this -14. So 5 minus 9 is -4, expected return 10, return 10, expected return 9, so 1, again return 15, expected return 9, so it's 6, return 20, expected return 9, so 11. Let's have a look another here. Return on project B is 35, expected return is 13, we get here 22, return 25, expected return 13, balance is 12, return 15, expected return 13, 2, return 5, expected return 13, so -8, -15, return expected return 13, so -28. Now let's make another final column here, which is return on A minus expected return on A multiplied by return on B minus expected return on B multiplied by probabilities. So basically we just calculate these two and multiply by 0.2 as probability. So -14 multiplied by 22 multiplied by 0.2, we get minus 61.20, -4 multiplied by 12 multiplied by 0.2, then we get -9.6, 1 multiplied by 2 multiplied by 0.2, we get 0.4, then we multiply by 6 multiplied by -8, 0.2, and -9.6 again, then finally 11 multiplied by -28 multiplied by 0.2 probability, then we get 61.60. So in this way, at the end is covariance return on A and return on B is equal to, if we add up all of this, we get the final value is minus 142 is our covariance. Similarly, now let's calculate the correlation between returns. What is correlation between returns? It measures the degree of relationship between two variables or two assets. The value of correlations lies between +1 and -1. The formula is, it is symbolized by rho AV, where covariance of return on A and return on B divided by standard deviations of assets A and standard deviations of assets B, where R and RV is equal to covariance between A and B, rho AV is equal to correlation coefficient between rho A and rho V. Sigma A is equal to standard deviation on assets A and sigma B is equal to standard deviations on assets B. We are already given here the standard deviations on assets A is 8.6 and standard deviations from assets B is 17.2, and we just calculated earlier here the covariance is between return on A and return on B is -142. So let's simply put all these values on this formula. So rho AB is equal to covariance A and B is -142, standard deviations on assets A is 8.6 multiplied by standard deviations on, which is risks, return on assets B is 17.2. So simply let's calculate. We get 147.92 in this way, minus 0.959, which is close to -1. Similarly, let's calculate the variance on portfolio using covariance. Variance of portfolio using covariance is variance portfolio is equal to weight on assets A square variance on return on A plus weight on assets B square variance on return B plus 2 weight A weight B multiply by covariance return on A and return on B. So where we get variance is variance of return on portfolio, WA is equal to proportions of investment in first assets or A, weight on B is equal to proportions of investment in second assets or assets B. Variance on return A is equal to variance of return of assets A, VAR bracket B is equal to variance of return of assets B. Then finally COV RA RB is equal to covariance between assets A and B. We already know that there is a 50% of investment in assets A and 50% of investment in assets B. So 50% investment on assets A and 50% investment in assets B. Also, variance on return on A was 74, then variance on return on B was 296. Covariance is return on A, return on B is equal to obviously 142 minus 142, which is calculated here. The weight of assets 1 is 50%, which is square, multiplied by variance of return A is 74, plus again weight of assets B is 50% square, and the variance of assets B is 296, plus weight on assets A 50% and assets B is 50%, multiply by finally covariance minus 142. In this way we get the result 21.5. Similarly, we can now calculate the risks or standard deviations of portfolio using covariance. So formula here is standard deviations of portfolio covariance is simply we just square root, which is weight of assets multiplied by variance on return on assets A plus weight on assets B square multiplied by variance on return B plus 2 weight of A and B multiplied by covariance return A return B of we already got the value here is 21.5. So we simply square root of this, then we get 4.64%. Students, now let's have a look at another very interesting and important topic in risk and return theory, the capital assets pricing model. What is capital assets pricing model? It is developed by Professor William F. Sharpe in 1946. It determines the required rate of returns of assets and then use the rate to estimate the price of assets. There are various assumptions. The assumption is model assumes all the investors are risk averse. That means they don't like risk. They want to averse the risk. They want to avoid the risk. Investors have no constraint on using borrowing or lending money, so they can freely get money from bank or wherever in markets. All investors have homogeneous expectations. All investors have common investment horizon, so they are going towards same horizon. And all investment are definitely divisible and manageable or measurable. Tax and transactions costs don't exist, so there is no tax in transaction cost. The capital market is in a state of equilibrium or striving towards the equilibriums. To further explain the theory, this is the security market line. The y-axis is expected rate of return and the x-axis is the beta coefficients. And this is the line SML, which is security market line, and this is risk-free. RF is equal to risk-free rate. ER we know, ERM we know that expected rate of return. Beta is market risk on assets J. Now let's have a look this diagram or figure very closely. This is risk-free rate of return and above that is expected rate of return, and this is security market line. So for example, this is our equilibrium point or market equilibrium point, where perfectly the expected rate of return is perfectly matched with risk-free rate of return and security market line. And the assumptions are all assets must fall under the security market line, which is this one, security market line, and assets lying above consider underpriced, and assets lying below this security market line is overpriced. So this is our equilibrium point. For example, the assets here is A point, let's have a look this, and this is B. We have the security somewhere over here, point C, our beta is 1. So at point C, the expected rate of return is higher than point of A, with the same level of the systematic risk. Whereas, for example, point here is let's have a look this point D, expected rate of return is 0. So at the point D, the expected rate of return is below than market, but the risk is high. So in this way, both C and D point is not ideal point. Only this point A and B, assets that lies in security market line, is the ideal assets to investor. E R J is equal to RF plus expected return on market minus risk-free return multiplied by risk or beta j, where ERJ is equal to required rate of return on assets j, RF is equal to risk-free, ERM is equal to return on market, then beta is beta value of jth. Students, now let's have a look what is beta and how do you calculate or how do you estimate the beta or risks. We have a formula here. Beta coefficient is written as COV J and M divided by sigma market square, where COV of J and M is equal to covariance between return of jth assets and market, then sigma square M is equal to variance of market. Example, covariance between the return of stock J and return on market is 20% and variance of market is 16%, then we can calculate beta of the stock J or BJ is equal to covariance of JM divided by, which is covariance is 20% and variance is 16%. In this way we get value 1.25. Let's take another example. Assume risk-free rate of return is equal to 5%. Market return is 12%. Then beta coefficient is then calculate the required rate of return CAPM. So we know the formula that expected rate of return on J is equal to risk-free rate of return plus expected rate of return on market minus risk-free rate of return multiplied by BJ. We know that risk-free rate of return is 5%, expected rate of return on market is 12%, 12 minus 5, and beta coefficient is 1.2, 5% 7 multiplied by 1.2, and finally 13% is a market return. In the similar way, we can calculate the portfolio beta. Let's have a look this example. The first column is stocks, second is the investment made on those stocks, the third is weight, fourth is beta, and last one is weight of beta. So stock A has got 40,000 pound, B has 50,000 pound, and C has 30,000 pound. So altogether is 120 pound. So let's find out individuals stocks weight. The stock A's weight, we find out 40,000 divided by 120,000, then we get the weight of 0.33, and 50,000 divided by 120,000, we get 0.41, and finally 30,000 divided by 120, 0.25, and we know that the beta for stock A is 1.2, the beta for stock 2 is 0.9, then beta for stock C is 2.1. So we want to calculate the portfolio beta. We simply multiply the weight of the individual beta and add of this, that makes the portfolio beta. So let's multiply 0.33 by 1.2, we get 0.396, and multiply 0.41 by 0.9, we get 0.41 multiplied by 90, 0.369. Then let's multiply 0.25 by 2.1, 0.525. In this way, our total is 1.29 portfolio beta.